Long considered the world's most valuable and widely recognized safe haven asset, gold is also used as a barometer for economic health. Rising gold prices are said to be a direct consequence of inflationary policies and, in turn, economic instability. According to economic theory, prices for consumer goods are supposed to decline under a healthy financial system due to increased manufacturing productivity and efficiency. Lower gold prices, on the other hand, reflect a healthy economy. Without the need for a safe haven asset, consumers freely and fully participate in the financial system. The recent collapse in the Dow Jones Industrial Average should, according to conventional wisdom, be extraordinarily bullish for gold and the precious metals complex. However, this has really not been the case. Despite a few token surges in bullion investments, gold prices have largely been outpaced by equities and even crude oil in the recently labeled rebound rally. Gold is actually down for the week beginning August 23rd, denying a three-peat. What gives? Shouldn't gold move up when equities move down? Yes, some analysts may argue, but the current dynamics introduced a shock to the financial system, thereby negating established expectations. But if that argument was valid, we would expect to see an inverse correlation between gold and equities over a long-term chart. But that is not what we see at all. From 1970 until 2014, average price points for gold and the equities benchmark S&P 500 index have largely shared a strong direct correlation. In other words, outside of a few exceptions, as equities rise, so too does gold. How can that be? Gold is a reflection of fear and uncertainty, while equity rallies indicate confidence in the financial system. While our eyes may play tricks on us, the numbers don't lie. Over the past 4.5 decades, gold trades along with stocks, not against it. But the story doesn't end there. More often than not, our answers require the right question, and the question in this case is not whether aggregate gold prices and equity valuations are incongruent with each other, but rather if total sentiment for gold is inversely related to sentiment for the stock market. The distinction between aggregate price and sentiment is an important one, which is typically ignored by both the mainstream and alternative media. Pricing of assets includes speculation highs, which naturally drive up average price levels. The stock market in recent years has generously received such benefits with multiple record-breaking moves across the major indices. But where does most of the trading activity occur within the boundaries of extreme highs and lows? This established trend to speculation ratio reveals a critical weakness in the stock market where speculative trading has exponentially outpaced foundational support. It's clear that in terms of sentiment, stocks move in predictable bullish and bearish cycles. Subsequently, gold sentiment also moves in predictable cycles, but almost exactly in the opposite direction of equities. While it may not look like it on a typical price chart, gold is actually far less speculative than stocks. While precious metals obviously have boom-bust cycles, they do not outpace foundational support in the same magnitude as stocks. So don't believe the mainstream fear-mongering. Gold is far from dead. Thanks for watching.